Welcome to Kicking Ass and Taking Names, the Business Owners Empowerment Podcast. I'm your host, Marlon Griffith Esquire. Join us on this podcast journey as we help you break free from the grind and get your business to work for you. We will delve into impactful conversations with business owners, corporate leaders, professional service providers, and industry innovators that will provide you with insights and actionable strategies that will transform your entrepreneurial path, boost your success, and put you in control of your business journey so you can kick ass and take names.
The CFO is there when you're going to hire any new role you haven't had before in your firm, whether it's a marketing assistant or an executive assistant, or it's an office manager, or it's a COO. Through the gamut, your CFO is there to help you understand how that role can contribute to the bottom line of your business. Every role in any business, every person who works there is not an expense. They're an investment because everybody should contribute to the bottom line. And that's the other thing the CFO can help you connect the dots on.
Yeah, that's very, very insightful, very helpful. Because I've found that a lot of business owners, when it comes to, they may have an accountant, or they may have a tax preparer,
yes,
and they may have a bookkeeper, maybe, or they use some type of software system or what have you, or they have their,
sure,
or they may have their assistant put in numbers, whatever it may be. But very few really have a CFO. They may call the individual a CFO, but that individual is not really serving CFO functions as you described. They're really more maybe financial controllers.
Yes.
They're basically, what I call it, they're after the fact.
Yeah.
They're, as you said, putting numbers where they belong, maybe making sure that certain bills could go out and figuring out what's owed and what's not owed. And obviously creating all of these documents that's very relevant to tax preparers and what have you.
And all of that is important.
Very important.
But I can tell you, it's not for, and I can tell you one good question to ask yourself when you're dealing with somebody. Let's say you just had a meeting with this financial professional, no matter what they're calling themselves. At the end of the meeting, ask yourself, did we spend this meeting looking in the rearview mirror or out the windshield? And if the answer is we spent the entire meeting or 90% of the meeting looking in the rearview mirror, you potentially don't have somebody truly serving in that role of helping you move forward, grow the business, and make decisions. If you really didn't talk about anything, upcoming plans, upcoming investments, growth strategies, projecting what cash flow is doing, projecting revenue, if you didn't do anything looking out the windshield, you were shortchanged.
Let's talk about you call it the 5 red flags. And when you are, let's say you get to the point where you're now considering engaging a CFO, a fractional CFO, or a full-time CFO, what are those 5 red flags you should be paying attention to?
Completely. And I really consider these the red flags dealing with any financial professional. If you sense any of these red flags with anybody who's serving you as a tax accountant, a bookkeeper, a controller, fractional CFO, personal financial advisor, these are my big red flags that you potentially need to think about replacing that resource. The number one thing is missing deadlines. Let me give you a true story. I was working with one of our clients at How to Manage, and this was early in the year, and we had a CFO call, and she needed to get some things to her tax accountants. She wanted me just to look at it and make sure I felt like it was all solid and finished and ready to go to the tax accountant. This like in February, and I said, yeah, absolutely. Let's all go. Just send it off, right? And then a couple of months later, I said, you know what? Whatever happened with did you end up having a tax? Because she was concerned she was going to owe some additional taxes, the nature of her call. And then my first call in May, I went, hey, I never had an update from you, but I was curious. Did you end up owing a lot more on taxes than you thought you were going to be? And she said, I don't know. I'm like, what do you mean you don't know? She goes, I never heard back from my tax professional. I said, pull up your email and email them right now. like never heard anything from her CPA. They did not file an extension and they did not file her taxes. They forgot. Literally, the certified public accountant told her they forgot. Are you kidding me? That's an extreme example.
Sure.
But if your bookkeeper owes you your reports by the 15th of every month and you never get them to the 20th, it's a red flag. So I'm not talking maybe like the one-off, one-day short missed deadline, but pattern of missed deadlines is a red flag. Because if they're this disorganized with their time and this disorganized with their commitments, do you really want them involved with your money?
No.
My second red flag is that they never really ask you any questions. You meet with this person and they just kind of lay out how things are going to be and how they do things and what they're going to need from you. Any financial professional who just really has their own like set ways and like they're a train on the track and you just need to get on because this is where the train is going, right? And again, everything from your bookkeeper to your tax professional, I'd be scared to death of the tax professional who never asked me one question in the preparation of my taxes.
Evelyn, that's funny because that's a red flag for a lawyer as well, for hiring a lawyer. If you
yes,
lawyer, don't ask
absolutely.
Anything, just give you a rendition like they're
right.
all for. Yeah, that's problem.
Yeah, huge red flag. Again, if you have a meeting with one of these professionals after the meeting, literally say, or keep a Post-it note. Like this is my little trick too. If I'm keeping track of something, I just have a Post-it note. And if I'm trying to keep track of something, like how many times somebody says, while they're talking to me or something else annoying, and I just like tick mark it, right? Keep a Post-it note in front of you and just make a tick mark every time they ask you a question. You get out of that meeting and there's nothing on the Post-it note, you've got your red flag. Big red flag if they really never ask you any questions. My third red flag is their inability to communicate effectively. So they say something you don't understand and you say, that kind of went over my head. Can you say it a different way? And they literally say it exactly how they just said it.
Right. Mm-hmm.
That's actually a red flag that they don't know what they're talking about. And you're not dealing with an accountant, you're dealing with a parrot. I find when somebody can't explain something a different way, it's because they actually don't really understand it. Mm-hmm. So this is a red flag for incompetence. Okay. And so, they can't communicate effectively. It is a huge red flag. This thing included in there is the people who are like talking over your head, technically. And again, we as adults and as the human species, we've been trained out of trusting our guts a lot. Let me tell you, the subconscious mind is almost infinite in what it picks up as compared to our conscious mind. You just get this, if you can't put your finger on the reason why, but you're just left with the impression that that person just wanted to talk over your head and BS you. Trust your instincts. And it's the last thing you need to be dealing with, again, when you're dealing with your money. It can really be a red flag, honestly, on somebody with not great intentions.
Sometimes not great experience either.
Exactly.
Right.
Exactly. But if I'm kind of a little bit of a white collar crime. I like to study white collar crime. And if you really go back and look at white collar crime and you look at the things that have happened, I've watched a lot of documentaries on this. Inevitably, there's a scene in there, or replay, or in the testimony where somebody was talking and the victim really wasn't clear on what they were talking about. It's a pattern. And so I'm not telling you every person who does that is a white collar criminal.
Right. No, we're not saying that.
No, but I'm telling you, if your gut is telling you that's your impression, A, you just don't need that frustration in your life. Yeah. And B, you may dodge a bullet. That's what I'm saying.
I mean, I agree. Because in my profession, I've always said, you should be able to explain anything to your client about the case or about what it is you're doing in plain English.
Yes.
And, I mean, that's probably what we have to reduce it down to, something that's understandable to the client.
Absolutely. And I can tell you, I mean, I worked with a lot of lawyers when I was a partner in that business. I worked with litigators like yourself. And let me tell you, the ones that were most successful for my firm are the ones who are very clearly able to articulate the strategy and why that was our strategy going into a particular negotiation or dispute or resolution or mediation, XYZ. And those are the very best litigators out there who can really, they don't just say, trust me, they help the client understand why this needs to be our strategy because of the potential outcome. So you're 100% right.
Right. And they do that because it's like, as you're saying with a fractional CFO, they can be effective that way because they listen to the client.
Exactly.
And they learn the
Exactly.
business, the particular business related to the client, and then uses the legal acumen, or in this case, uses the financial acumen to advise the client, the business owner going forward as
Absolutely.
to forecasting certain things for the business client. Because they're not
Completely.
talking about what you did 5 years ago, what you should have done, which is often the case with a lot of financial, I don't even want to use the word CFOs anymore. They call themselves CFOs, but they spend a lot of time talking about what you should have done. Why did you do this? And not really helping you forecasting and going forward.
Right, exactly. And that's at some point, I mean, when you lose, don't lose the lesson. But once you've got the lesson, hey, let's move on.
Yes.
Let's move on.
Absolutely.
So my fourth red flag is they can't explain what they've done or why they did it. You get your tax return back and you're like, why did you call this a long-term capital loss? Or why did you put this as a certain type of itemized deduction? Or where did that come from? They can't explain it to you in a way you understand. They can't explain why they did something the way they did it. As simple as your bookkeeper or controller rearranging something on your chart of accounts. Why did you do that? They can't articulate a good reason why. It is a red flag. Because I literally, true story, had a person who came to How to Manage, and they signed up for Fractional CFO, and I got their first set of financials we'd ever seen. Their bookkeeper on their balance sheet had capitalized a fixed asset and was depreciating it. That was a $50 trash can from Office Depot. That's called the Bookkeeper Full Employment Act. Who the hell is depreciating a trash can? Like, again, and this bookkeeper was charging them a ton because she's maintaining this huge file of fixed assets. Because, I mean, like the trash can and every desk, and it was insanity. So my point is, when something doesn't make sense to you, they need to be able to articulate why. And again, your instincts, if you think they're BSing you, they probably are. And then my fifth red flag is just somebody that when you're meeting with them, never demonstrates any knowledge about what's going on with trends or new regulations in the industry or what's going on in the financial space, right? Somebody who just is never talking about anything related to what's going on in their area of expertise, especially like, tax laws are constantly changing. This was very evident when the CARES Act came out and we had, PPP loans and the EIDL loans available. If you were in that 2020 to 2021 period and you're working with a controller or a fractional CFO who isn't talking to you about the CARES Act and the benefits available, the employee retention credit, is somebody who's not talking about all those things, that is a red flag. Somebody who literally never brings it up. I don't know if you remember last year, there was I think it was a Silicon Valley bank that failed in California. Big reminder, make sure you don't have more than that 250 FDIC insured deposits in one bank. I reminded every member I worked with, it was just a reminder that you're potentially exposed. The bank assets can't cover, right? The deposits that you had at the bank, and again, when you're a business owner and your business has grown, you may actually have that level of money in a bank account for the first time in your life and not realize that the deposit insurance caps out. And so again, you don't know what you don't know sometimes.
Sure.
And so I think it's really important that you're dealing with a financial professional that demonstrates to you in some manner they are keeping up with the standards in their industry, the news in their industry, changing laws or changing perceptions on the way things are handled.
Okay. All right. So I want to now actually go back
Okay.
to your experience at Serious Solutions, but
Sure.
specifically, because one of the things we talked about was partnerships.
Mm-hmm.
As you mentioned earlier in this podcast, you ultimately became a partner in that company.
Yes.
And you have some very strong views about partnerships.
I do.
Litmus test, which I just love. Your litmus test.
Yes.
So
Yes.
let's because obviously many business owners are partnerships, right? It's
Mm-hmm.
usually more than one person is part of the business. And I usually say that's like your other spouse.
Mm-hmm.
Is your business spouse, right?
Right.
Sometimes spouses can make more than one individual. And there's certain, not necessarily bad, but it's obviously there's certain issues that are played in a partnership when it comes to running a business, right? So let's talk about that.
Yeah, I'd love to. So we went from 10 equity partners up to 16 and back down to 8. And I have the scars to prove it. And when the key shareholder, the largest shareholder, would come to me at a point of talking about whether there was somebody we wanted to offer to be part of the partnership, and would ask me what I thought, I said, well, I really put one thing, my litmus test on this is this. Inevitably, something will happen day in, day out, quarter in, quarter out, where there'll be an issue we've got to deal with, an irate customer, a threat of a lawsuit, an employee threatening, that something inappropriate happened, XYZ. I said, it's going to hit the fan periodically.
Mm-hmm.
Am I 100% comfortable in a crisis with this person having a vote at the table? I think if you're going to be in business with people, I think it is actually really good if you aren't like cookie cutter people. Like being in a partnership of somebody exactly like you, I don't think is a great answer. I like different backgrounds, different experiences, different strengths. Like not everybody in our partnership was a hell-bent financial person, right? Some of them had an IT background versus a compliance background versus an internal controls background. That diversity for a management consulting company made us stronger because we weren't all a bunch of cookie cutters. But when push came to shove, was I comfortable dealing with a crisis with this person having a vote on how we were going to address the crisis? That was really my number one criteria with it.
You also talked about, and you've spoken to me about when it comes to partnerships, you talk about don't give up your equity. What do you mean?
Don't give people equity because you have built a business that has got some value to it. And then you turn around and you want this person to be a partner in the business, right? Don't just give them 5%, 10%, God forbid, 49 or 50% of the equity in the business. Anybody who's given equity doesn't appreciate the value of it. Everyone should have to pay for equity. Now, you can't have an income-only partner. We had some partners that were income-only. And again, we were not a law firm, so we had some more freedom than maybe a law firm has. So basically, an income-only partner was somebody who had the title of partner, really was using it to help them with business development, and they had a profit-sharing arrangement with us. Good, fine. They didn't buy equity. They didn't have equity. We didn't give it to them. I bought my equity. I bought in my equity over 5 years. I bought in equity and it was close to the same purchase price as the house I was living in at the time. And you value it more when you really realize that you're buying an asset. Giving away the equity is diluting what you've done with the business. And inevitably, people don't then appreciate it and just look for a way to exit it. And then you're paying them out and they never paid in. So I'm very, very much against giving away equity. I'm really okay if you sell it to them at a discount of what we believe the current book value or market value of the company is. And by the way, book value, market value, two totally different animals. Don't ever get them confused. They're not synonymous. But I'm okay if you give somebody a bargain that I am not a fan of ever giving away equity. I'm not.
It's interesting because in my experience with a lot of clients, sometimes clients, as you said, they grow and they want to expand and they want to bring in new members, new partners to the business. And one of the things that I've found that's not necessarily fully contemplated is, oh, well, how much is my business worth? How much is the equity? How much is the percentage? How much is the share worth? Right.
Well,
and goes back to financial controls. It goes back to to all of the reports that you use that you're supposed to be looking at to get a sense of truly what is your as we say. And I want to actually talk about the book value versus the market value, because the book value is really in many ways underestimated. Let's just say undervalued in the sense that people don't really consider it.
Right. I actually did an analysis on this for my financial literacy class that I run. Public companies, market value is easy to find because they're public companies. So you can go capture that market value. So I went and looked at 5 different publicly traded companies, and I actually pulled their financials as of a December 31, 2023. So I went and got their book value, and these are large multi-million-dollar companies. They got more damn accountants, than you and I even want to think about, right? And they aren't a privately owned business. So people aren't taking like owners' distributions, and they have distributions related to their stock. But my point being, the book value is probably even a little bit more stable, right? Because they're these huge companies with public shareholders. And then I compared it to their market value. Generally speaking, I was seeing market value at anywhere between 5 to 10 times more than even the book value in these publicly traded companies. Now, is that some sort of like rule of thumb? No. But this concept, if you own a small business, your book value is not your business valuation. Your business, especially if you're professional services, your greatest assets go home every night and kiss the dog. Okay. As a law firm owner, one of your biggest assets is your law firm's reputation. Isn't a law firm that's been around, how long has your law firm been open, Marlon?
15 years.
All right. Your law firm's been around for 15 years. What if there's a law firm that on paper looks like it does the exact same thing you do and they're 3 years old? Who has more value? That's not on your damn balance sheet, Marlon. But it's true value for your business, right? And again, it's no discount to the people who are smaller or shorter lived law firm. It's just the reality, right? So your client list, chances are you've got a much larger client. If you've got a much larger client list at your law firm versus law firm B, you've got an asset that law firm doesn't have. So a lot of your assets, a lot of the things that create business value aren't necessarily on your balance sheet. That doesn't mean the accounting is wrong. Accounting is following a 10,000-year-old system of how we put together a balance sheet and a P&L. But it's, even though something can be accounting on the nose with precision, it doesn't mean your book value has an equitable relation to your business valuation. Your business valuation is much bigger than your balance sheet. I like big business values, and I cannot lie.
I love you, Evelyn.
You are funny. Hilarious. Take you to Seattle now, right? The best song. So the banking partnership and
Yeah.
and let's assume that you want to bring in someone.
Uh-huh.
And the deal is they want equity.
Yes.
How does your fractional CFO assist you? Because again, let's put this scenario. You want your company to grow, and you see maybe some potential opportunities, areas in which your company can grow, but you realize that it might be certain expertise that you don't have,
Absolutely.
someone else may have, whether as an individual or a company, another company, and you decided it may be worth it for this individual and our company to become part of your company.
Sure.
And they're only willing to do it, obviously, because if they can have equity in the company.
Yeah,
And
absolutely.
CFO now, you discussed this, and what role should a CFO now be playing in that?
Right. Well, there are people who do business appraisals that do this very thing I'm talking about when it comes to book value versus a business value. Now, business appraisers may follow a formula that may not think about everything that adds to the business value. So I would encourage, if I'm your fractional CFO and you're the business who's considering bringing in an equity partner, I'm going to help you brainstorm on everything we need to make sure that appraiser thinks about when they're putting together your business valuation. Okay. And a business appraisal, I mean, the cost of doing this ranges, okay? It can be a couple of $1,000s. For a business that we had when it was at 50 million, I think we paid about $15,000 to have a formal appraisal done on our business. So there's a range here, and there's some relativity to the size of the business. So I'm going to coach you, the business owner, on making sure the appraiser knows everything I think they need to know about the business value. And let's say they come back and I'm just going to use a round number. They say your business is worth 10 million, right? A business value of 10 million. Okay, it's a starting point. Again, I'm okay if you're like, you know what? I'm going to let them buy in at 25% equity, but I'm going to let them buy in as if the business is currently valued at 7 million or 5 million to kind of give them an easier way to buy into the equity. I'm okay with, if you will, discounting this, but we got to know where we're standing. I say brown numbers, pulling a number out of your butt is not a good strategy on this.
Right.
The other thing is, if you're thinking about having the business appraisal done, what I would honestly do before I even took that step is this. I would draft a partnership agreement, and I would have the person that you think wants to buy into that equity look at it and make sure they really understand what that means. Because that means if we ever wake up on a Friday and we can't make payroll and you're a 25% partner, you're chipping in 25% of the cash. There's a lot of upside, but there is risk. There's risk in every business. High risk, high reward, people, right? So I would honestly draft a partnership agreement and have them review it as a way to see if they're really serious about this and they're willing to take the risk for the reward, right? And then maybe even, let's say, again, say you got this $10 million business valuation. You say, you know what? And you stick with me. And when we'll repeat that business valuation 3 years from now, and whatever it has increased by, some certain percentage of it will correspond to some bonus equity I'll give you. I will give you 5% if we get in the business valuation to 20 million in 5 years. You can do something like that because if they're already buying in on their core equity, I'm okay if you say, if you help me reach to a certain milestone, there's some bonus equity in it for you.
Evelyn, what you're saying, and you're just using an example, obviously, in this instance. But the real lesson is, and I spoke about this in or maybe one of my prior guests, where we spoke about creating your executive level team, right? Which includes your legal officer, and all can be fractional. Your CFO, your CMO, and all of your COO, right? But this is an example where the team works together, because
Absolutely.
what you just described would be something where, for example, the fractional CFO would be really in tune with asking questions that with the appraiser or the evaluator, and then discussing that with the legal officer to try to draft an agreement that basically spells out what you just said.
Exactly. And
I think
again,
often, my clients come to lawyers and expect the lawyer to create the agreements with all of the terms in there that sometimes the client has not anticipated. And what
correct.
we're really here to do is to create a document that reflects exactly what the agreement is, while minimizing your exposure, minimizing your risk, and giving you the greatest benefit.
Absolutely. And again, the fractional CFO coming with an outline of a term sheet of where we want to start, right? On this, again, how are we going to handle cash calls? Is this partner going to be expected to now sign on with a personal guarantee on all the existing debt of the business or not? Like, the fractional CFO is to help you think through these things. That actually helped the reverse. We had a partnership I was working with as a fractional CFO, and the two partners actually very amicably decided, you know what, we're going to go ahead and break into two law firms. We've grown this far together. I think it's time we just go ahead and separate our practice areas and do this as two firms instead of one. I talked them through, okay, y'all have a loan you're both signed on. You need to go to the bank. We need to sever the loan and sever. I mean, and then they dealt with a business lawyer to help draw everything out. But I helped them break, because the business lawyer didn't necessarily know all the ins and outs of the financials of the company and how they had split distributions to this point, and the money in the IOTA. I had to help them do the math on what money in the IOTA belonged to each practice area, and document it in their trust account to make sure it was split correctly. I helped them figure out, I kind of let them know where all the things were, right? Kind of like the inventory of things. And then the business lawyer made sure there wasn't things we hadn't thought of, helped us do a risk assessment, helped us mitigate any risk, and then helped paper it completely. Right. It's very much a partnership with your financial professional whenever you're talking about a significant change in ownership of a business, whether it's a separation or an additional partner, for sure.
That's right. And that's a great point, because often when I do litigation related to partner disputes, because they're separated, often the reason the disputes grow into what they grow into is because a lot of this had not been done. Right?
Don't you ever run into them when they're either not papered or not sufficiently papered from the very beginning?
Exactly. And I've always said the best time to make agreements is and put them in writing is in the beginning, when everybody's in agreement.
That's why that's also why you do a prenup.
I hear you. I get to that. I've heard that. Heard that. But I think it's very important, because folks, when they're ready, whether establishing a business or they're trying to have somebody join their business, and they're very excited. I understand, because they see the opportunities. But often all we see is the opportunities, and it's the other professionals that should be part of your team that kind of see the risk as well. And it's all about papering it to kind of minimize the risk, so you can really maximize the value. And that's what I try to share and preach, if I can say that word, preach to business clients, right?
Absolutely.
Is about minimizing risk, maximizing profits. And the easiest time to do it is at the beginning, when everyone is getting along.
Which is also why, when, say, you hire an associate into your firm, even just an employee, anything you need them to agree to, you agree when they're all happy to be joining your firm.
Right.
We agree that communications will come from the firm at the point you choose to separate. Again, look, it's not about taking advantage of people. It's about boundary.
That's right.
And I can guarantee you, anybody who goes into a partnership without a partnership agreement has got boundary issues in other areas of their life.
Could be. That could very well be true. It's always challenging and, quite frankly, more costly in litigation, where we have to start relying on emails and other things that's written and set an agreement, right? Or because we didn't do it. We
right.
didn't want to get to it or what have you. And again, the law recognizes different ways of trying to get these things resolved, but obviously it becomes way more expensive and, more importantly, a more stressful process.
Let me tell you, I honestly think what you just said, the stress it incurs when you have got this going on and you don't have anything papered in a way that is concise and precise. I deal with lawyers who deal with all kinds of issues in their law firms and so forth. And I'm telling you, what kind of a distraction is that to you as a business owner? How can your business maybe even survive or less thrive if you're completely distracted now dealing with this legal issue?
Right. That's right.
It derails your focus and it derails your growth, and it can really, really mess with both your conscious and your subconscious at a level that can affect your health, your family, and everything else. This stuff doesn't happen in isolation at all.
And I would share a personal story relating to my business, right? I mean, you asked me how long I've been an owner. It's been 15 years. But actually, this year is what I call my 10-5 anniversary. So it's actually my 15-5 anniversary. The 15th year of being a business owner of a law firm, but it's my 5th year. Literally, June is my 5th year of being the sole owner of the law firm. Because 5 years ago, my partner left she's now a judge in a nearby county. The story I really wanted to share was when we decided to become partners, both lawyers, we went to another law firm to draft up an agreement for us.
Mm-hmm.
We didn't do it ourselves, even though I were capable of doing it, but it's really to have a third party.
Absolutely.
And that agreement, and we did it, and then 10 years later, the agreement mattered.
Exactly.
Right?
And by the way, that's the exact advice I give our members that are either adding a partner or they come in and I realize they're in a partnership without any paper. I'm like, you need to put a partnership agreement in place now. Better now than never. Yep. And they're like, well, no, you're going to go to a business attorney and you're going to have them do this and do it right. So you're an example of the right way to do it. 100%.
I've always, my general thought is, if you're giving advice, you should be learning in the advice you're giving, and you should be practicing the advice that you give.
Absolutely.
Right. Which is why I was so happy to have you on my podcast, because, as I said, and I've shared this with my audience, a few years ago, when I realized there was a difference between having a law practice and having a business in which I provide legal services. This is completely two different things. Right. And I'm now giving folks insights into, people like you that I've encountered and have shared the information that you've shared, and obviously in more detail. That's greatly helped me understand what it's like to actually work on my business, not for my business.
Exactly.
And it's been a tremendous help in how I provide advice to my business clients.
Absolutely.
Because I understand it from a business owner perspective.
I love it.
So we have now unfortunately, we've come to the end. And what I've always done is, if my guest is, this is if it's advice that you could give business owner, right? And that you haven't already, because you've given some great advice thus far. If there's one thing you would give as advice to a business owner, what would it be? The floor is yours.
As a business owner, you're going to get pulled left and right at your business day in and day out. Make it a priority that the first thing you do every single morning, even before you open your email, is you do something that is going to add to the top line of your business. Nurture professional relationship, respond to the information you owed your marketing vendor. If you prioritize 15 to 30 minutes, the very first thing of your day, always doing something that's going to add to the top line of your business, it will have the greatest return for you for that 15 or 30 minutes of pure focus and priority. That is how I grew my book of business, the sales, business development I was doing annually. When I made that change, I went from originating $2 million a year worth of business to 5.8. And that was it. That was it.
Awesome advice. Well, Evelyn, I look forward to seeing you and that's one of our quarterly meetings.
Absolutely.
And it was awesome. I thank you so much. And this wraps up this episode of Kicking Ass and Taking Names, a podcast for small and mid-sized business owners on law, business, and life.
Thank you, Marlon.
Bye-bye.
Bye.
Thanks for tuning into this episode of Kicking Ass and Taking Names. Remember, information is only as good as its application. So apply these insights and strategies and start making transformational changes to your business and life today. If you have not already, please subscribe to this podcast on Apple Podcasts or Spotify and YouTube. Keep kicking ass and taking names.